I am Black Rabbit. Bitcoin's liquidity black hole is coming. When demand exceeds production by 28 times, price becomes the only pressure release valve. Today, April 12th, 2026, Bitcoin is at 72,000. I already saw this extremely brutal, yet undeniably real financial truth long ago. Back in November last year, I said 60,000, had no bubble, and I had already gone 2 times on Bitcoin. Bitcoin is now entering a physically no coins left to sell phase. The code has locked new supply forever, while institutional rigid demand is expanding at an almost infinite speed. Traditional PE ratios, PS ratios, and DCF valuation models have all completely failed. What remains is pure mathematical compression. The supply-demand equation is crushing everything else in an exponentially imbalanced way. Data-driven knockout blow. What does a 28 times gap actually mean? Using the latest on-chain data from Glassnode, we can build an extremely simple yet shockingly powerful supply-demand equation. After the 2024 halving, Bitcoin's daily new supply has stabilized at roughly 450 coins, 3.125 BTC per block, per 14 blocks per day. At the same time, institutional and high net worth daily buying demand has ballooned to over 12,000 coins, creating a staggering 28.4 times supply-demand gap. Ratio D divided by 450, approximately 28.44. This means that for every 1 Bitcoin produced, 28.4 fund units are already queued up, waiting to adopt it. A mismatch of this magnitude is unimaginable in any traditional commodity market: oil, gold, copper, etc. If this happened in the global grain market, the price surge would trigger social unrest, but in the Bitcoin market, it leads to only one outcome: a violent, irreversible upward shift in the price center of gravity. The gap is not volatility, it is a structural fault line. The 3 pillars of rigid demand. Why they don't look at price, only at position size. The reason the rigid buy side I keep talking about is so terrifying is that these 3 forces have near zero price elasticity. They are not investing in Bitcoin. They are allocating to a strategic asset. By April 2026, these 3 pillars have evolved into a mutually reinforcing iron triangle. 1. ETF passive swallowing mechanism. Spot Bitcoin ETFs are backed by trillions of dollars in traditional wealth and pension systems. For giants like BlackRock and Fidelity, Bitcoin has become the beta of asset allocation. No matter whether the price is 100,000 or 200,000, as long as clients need to allocate, fund managers must buy the full amount at market price. Year to date in 2026, ETFs have already seen net inflows exceeding $57 billion, with single-day peaks hitting 471 million. This passive buying is completely detached from price sensitivity. 2. MicroStrategy's infinite leverage template. Michael Saylor's model of issue debt to buy Bitcoin, raise equity to buy Bitcoin, has become the textbook standard for corporate treasury management worldwide. As of April 2026, MSTR holds more than 767,000 BTC, with a target of 1 million. Through structural financing tools like STRC, they have achieved zero-cost leveraged expansion. The core of this demand is not short-term arbitrage. It is the ultimate hedge against fiat. The word sell simply does not exist in their dictionary. 3. LTH faith lockup. Long-term holders who have survived multiple bull-bear cycles have formed an extremely consistent psychological anchor. In their eyes, Bitcoin is not a commodity or asset. It is the ultimate money. Glassnode data shows that more than 70% of the circulating supply is now in a non-liquid state, with the average holding period hitting a new all-time high. Circle, Coinbase, and MicroStrategy's synergistic flywheel, the perfect closed loop of infrastructure, bridge, and template. If the 3 pillars are the skeleton of rigid demand, then Circle, Coinbase, and MicroStrategy together form the power system, driving this flywheel at breakneck speed. They have created an inseparable synergistic effect. Coinbase as the core infrastructure. As the world's largest compliant exchange and ETF custodian, Coinbase currently holds 80 to 90% of all spot Bitcoin ETF shares. It is not only the underlying pipe for trading and settlement, but also the main gate for institutional capital entering Bitcoin. In 2026, its institutional custody business has surpassed hundreds of billions of dollars, providing 24/7 uninterrupted liquidity and security for ETFs, MSTR, and others. Without Coinbase's custody capability, institutional scale buying could never be achieved. Circle as the fiat to Bitcoin bridge, USDC issuer, Circle's stablecoin supply has exceeded $78 billion and has become the most trusted dollar substitute for institutions in the crypto market. Through deep integration with Coinbase and the 2026 launch of BTC, a Bitcoin-linked product, Circle directly converts institutional fiat liquidity into Bitcoin buy orders. Enterprises and sovereign funds mint USDC via Circle, then seamlessly exchange it for Bitcoin on Coinbase, creating a zero-friction fiat stablecoin BTC channel. This bridging effect amplifies MSTR-style leveraged demand and allows rigid buying to run 24/7 without interruption. MicroStrategy, as the enterprise template and amplifier MSTR, is not only the largest single holder, but has exported the strategy model to hundreds of listed companies worldwide. Circle and Coinbase provide it with low-cost financing and execution channels, while MSTR's reverse demonstration further encourages more companies to join the Bitcoin strategic reserve ranks. The three form a positive feedback closed loop. Coinbase provides the entrance, Circle provides the fuel, MSTR provides the demonstration, together pushing institutional demand from linear growth to exponential explosion. This infrastructure, plus bridge, plus template synergy, far exceeds the power of any single institution and has become the strongest catalyst for Bitcoin's supply-demand imbalance. The short squeeze effect on circulating supply, a storm inside a glass bottle. Exchange BTC inventories have already fallen to historic lows. Glassnode data shows that the vast majority of circulating coins are in deep lockup. Exchange balances are like a reservoir being simultaneously drained by three super pumps: ETFs, MSTR, and LTH. When the reservoir is close to empty, while external fiat funds continue pouring in, the only balancing mechanism left is a violent upward move in price. Only when the price rises high enough to tempt some old money or LTH to release a small amount of coins can any trading actually occur. At that point, price is no longer a variable. It is the only independent variable. April 2026 verdict: the qualitative leap from asset to strategic reserve, as repeatedly mentioned in the group. The concept of national strategic reserve is no longer science fiction. When Bitcoin consensus moves from geeks to corporations, and then from corporations to sovereign nations, its very nature undergoes a fundamental leap. It has become a form of digital territory. Territory is not easily bought or sold. It is only exchanged at a sovereign premium. Based on the 28 times supply-demand gap, continuously shrinking exchange inventories, and the institutional iron triangle built by Circle, Coinbase, Strategy, we are witnessing the unprecedented monetary revaluation triggered by absolute scarcity in human history. In this equation, fiat is the denominator tending toward infinity, while Bitcoin is the fixed numerator of 21 million. We are watching the numerator's ultimate victory over the denominator, the structural wealth leap for ordinary people. Cognitive gap is the strongest moat. While most people are still panicking over 5% intraday swings, the real hunters have long been fixated on that 28 times supply-demand imbalance. That cognitive gap is your strongest moat in 2026. If you ask me what the future holds, I can only say math never lies, and code will never betray you. Bitcoin's victory is not a victory of faith. It is a victory of supply-demand mathematics, and we are standing at the very front row of this victory.